Having investment success is often as much about avoiding bad ideas as it is about embracing good ones. We've had a negative view about government bonds for many years, and we've been wrong every year. Well, I don't know. The fact that the investment did all right or even well doesn't mean you were wrong to avoid it, because the risk of doing poorly was still there. It's counterintuitive, but you actually make money out of government bonds when interest rates fall. When interest rates fall, it simply means that investors are paying more to buy existing bonds, so you make a capital gain. And interest rates have been falling. The longer this goes on, and the lower rates go, the greater the potential for loss. But at the moment we have a toxic brew. We have low current rates and low inflation, and there's a real possibility of an inflation spike. When rates start to move up again, there'll be some capital losses. The other problem is that the lower rates go, the less they compensate you for the capital risk you're taking. Long-term interest rates in the USA are currently around 3%, and in Australia they're around 4%. In both cases, inflation, even at the current levels, will consume much of the investment return. Owning international bonds can also be a currency play, a bet that the Australian dollar may fall in value. But we think you should be cautious. Those of us who lived through the bond crash in the mid-1990s know just how ugly a bond crash can be. The bond crash was in 1994, and in October 1994, Fortune magazine reported that in January of that year, bond yields had been historically low and inflation had seemed negligible. Wages were going nowhere and companies dared not raise prices. But 1994 became the year of the worst bond market loss in history. The article went on to report that the worldwide decline in bond values that year were in the order of $1.5 trillion. It should be noted that $1.5 trillion was a heck of a lot of money in 1994. And in those days we didn't have the extraordinary leverage we have today in the form of derivatives and hedge funds that can magnify actual losses many times over, as happened during the global financial crisis. We also retain our nervousness about traditional media. The issues are clear and the issues are unresolved. The revenue for traditional media has always been advertising, and as entertainment options continue to emerge, there's more competition for advertising dollars. Our sluggish economy will stay sluggish for a year or so more, and the overall advertising spend is likely to remain depressed. And for newspapers, the traditional rivers of gold provided by classified advertising have moved to the internet. No one buys the paper anymore to look up job ads or car ads or real estate ads. On the flip side, content is expensive. In the past, advertising covered much of, if not all of the cost of media content, so consumers have been trained not to pay for it. The challenge for traditional media is to make money in this difficult environment, and the options are tough. They need to either educate consumers to pay more, or they'll need to provide content more cost effectively. The second course could lead to a diminution of quality that would potentially destroy the product. Now, you could argue that all of this bad news is already in the price. With the exception of Murdoch media, the pricing of which we've never really understood, traditional media is currently very cheap. If a solution's found, or the situation doesn't deteriorate any further, this may be the buying opportunity of the century, but the jury is out. A basic error made by do-it-yourself investors is to be lured away from investment fundamentals. Put it down to overconfidence, one of the human traits that makes human beings generally bad at making investment decisions. People often deploy their investment superpower, the ability to see opportunities that others are missing, and they use it to overcommit to dumb things. Lots of times they might get success for a while, and that feeds their sense of invulnerability, causing them to do more and to ramp up the risk. And often there'll be barakahs with vested interests. During the mining boom, many traditional brokers happily assisted their clients to speculate on small mining stocks, and when the music stopped, substantial losses were made. Now you often hear the mantra that all you need to do is focus on good quality franked dividends and not worry about anything else. The brokers have found a new tune with a beguiling melody to lure punters into another stormy disaster. Don't worry about issues of asset allocation that would cause you to have an appropriate allocation to defensive assets. And don't worry about allocating capital to overseas investing. All you need to do is to focus on investing in blue chips that pay franked dividends. Don't be misled. Many people should have defensive assets in their portfolio to protect them against unexpected market setbacks, because market setbacks are never expected. Most of the time, you'll earn less by owning defensive assets, and you should still do it, either because your circumstances demand it or because you're not well equipped personally to deal with setbacks. You're sacrificing return for security, and you're doing it on purpose. The other lie is that you can get international exposure simply by buying Australian shares that trade overseas, or listed international investment companies that pay franked dividends. You don't need to use specialist international funds, and that's untrue. You can't get exposure to a vast number of important industries by investing in Australia, and what you're after is the best pre-tax result. Whether some of the tax has already been paid or not is of no consequence. A real problem is that you'll be lured into what have often been described as value traps, buying stocks that appear cheap, but they're really cheap for a reason. Some of the cheapest franked yield going at the moment is from mining support businesses. The prices have dropped in anticipation of a period of some difficult times ahead, and the yield could well be unsustainable. But you can also pay too much for good companies, as the euphoria about the yield mantra and the disappointment of falling interest rates lures you into investing in blue chips. There aren't any blue chips, by the way. Most of the high-profile disasters of the global financial crisis were regarded as being safe before they weren't. In the last 2 months of 2013, the Australian market retreated by over 6%, with the retreat largely being led by blue chips. ANZ Bank shares went down by 10%. The Commonwealth Bank shares went down by 7%. You don't necessarily sell just because your shares are trading at a high price, but it often makes sense not to buy. The greater risk is that interest rates will rise at some point, and you can lose money on shares in much the same way as you lose money on long-dated government bonds when this happens. We've previously mentioned the bond crash of 1994. It wasn't a great time for share investors either, I can tell you. Between the end of January 94 and the end of January 95, the market fell by 20%. Mind you, that was 20 years ago, so surely you must have learned quite a bit since then. Lamentably, those who don't know history are definitely doomed to repeat it. Last time interest rates remained low for a long time, investors started to invest in complicated alternatives to get high yield. These became known as subprime mortgages, and substantial amounts were lost. A phenomenon that bemuses us is the enthusiasm for the new breed of listed income securities being issued by the major banks that get gobbled up by the market, largely by private investors. Since the global financial crisis, there have been changes to the rules about capital adequacy of banks and what can be regarded as capital. For some time, the major banks have borrowed money on market at attractive margins above bank bills, sometimes above 3%. In recent times, the regulator has demanded the notes include a conversion to shares clause to apply in times of financial stress. Investors, in their enthusiasm for yield and buoyed by the view that our banks are the best in the world, have ignored the obvious trap. The idea of having defensive assets is that you're trading return in for security. You only need security when things are bad. If you're going to take equity risk, you may as well be getting the higher return that flows to equity. These new securities offer the worst of all worlds. You have the low returns of a defensive asset when you'd really like to own shares, and you have the risk associated with owning shares when you'd really like to own defensive assets. Finally, there's already been some exuberance about a resurgent building industry, and it may be sensible to be cautious. We're not the only ones suggesting that the building industry may do well, but some of the suggestions that we have a chronic shortage of housing may well be overstated. Prices are high and vacancies are low, and this indicates there's a shortage, but it may not be chronic. The logical first reaction to a projected lift in home building would be to buy the major supply firms, like Boral for the building and construction materials, and GWA Group supplying fixtures and fittings for bathrooms and kitchens. There are two major problems with this approach. The first is that these are cyclical stocks that go up and down through the business cycle. You not only have to get the timing right to buy, but you also need to sell them at some stage later in the cycle, and getting one timing decision correct is difficult. Getting two correct is really, really hard. An even more significant problem can be seen from the charts. The early movers have already pushed prices of these companies well ahead of the earnings justifiable price in anticipation of latecomers coming along to push the prices even higher. Boral's trading at almost 24 times the anticipated earnings for this financial year, and any increase in the profits over the next 3 years seem well and truly built into the price. If earnings disappoint, the price will fall substantially. Sometimes it's best not to invest, even if past performance has been good, and it helps to get informed advice.